babe, happy Valentine's Day. Aren't these gorgeous? Well, pack your bags. I traded them for the house. Hi, I'm Amanda. I'm the dumpster doggy, and welcome to a brief history of getting this bread. It's investing 101 topics, but told through a historical lens. I'm just here trying to help you get this bread, gain that grain, get a lot of this ciabatta. Okay, I'll stop. So here's a really spicy question right now. Are we currently in an asset bubble? One that soon may burst in the stock, real estate, crypto, or NFT markets. To try and figure this out, today we are going to be talking about market cycles, and specifically two big market busts and the booms and the bubbles that preceded them. And by the way, we are not going through this exercise because it's just really fun to see what kind of random ass shit us humans go bonkers for. Although that's fun too. Like a Furby selling for $1,700. Really? Like humans? No. Stop it. No, but we do it because we can become better investors if we understand and are prepared to handle the volatile nature of markets. Now, before we dive in, allow me to make a quick clarification. The stock market and the economy are not the same thing. The stock market is just that. It is just a marketplace for these investments that we call stocks, which are small parcels of company ownership. The economy includes the stock market, but it's much, much bigger than this. Think of the economy as if it's the entirety of the ocean, and you're just a cute little fish within it. Just like a fish might not realize it's in the water, you might not realize that everything that our money lives touch is in the economy. From the job you have, to the rent you pay, an unemployment check, to the Kraft mac and cheese you eat every single night for dinner. All of that makes up the economy. And when the economy is doing well, it expands, giving all of us fishies more opportunities within it. And when the economy isn't doing well, it shrinks like a lake in drought. And we call this a recession. So then the stock market, again, is just a marketplace for stocks. It's kind of like a mermaid palace within the ocean where the mer people go to trade sea pearls, probably run by these three blobfish. And now instead of expansions and recessions, stocks either gain or lose value. And when stocks across the board are gaining in value, we call it a bull market. When they're generally losing value, we call it a bear market. And that's really what we're going to be talking about today is bull and bear markets. Okay, let's talk about two significant periods in history where we saw big bubbles and then big busts. Busty bubbles. That would be a good porn name. Keep that in mind. Never have I ever traded my house for a tulip bulb. So we begin our historical journey with the Tulip Bubble, the first known bubble within investment markets. It all begins in 17th century Holland after the Sultan of Turkey introduces to Europe an exotic flower called the tulip. Fun fact, tulip means turban in Turkish. Not long after, tulips became a status symbol among the Netherlands elite class. Tulips were basically the original Birkin bag. And as tulips continued to gain in popularity, a disease called mosaic affected some crops, and it caused a flame of new color up through the petals. And these tulips, called bizarres, were cherished and demanded at an even higher cost than non-bizarre bulbs. Tulip dealers spent a whole lot of effort predicting what the following season's trends would be. They would even stockpile bulbs, which caused prices to soar. No longer just a fun, springy, bulbous herb, tulips became investments. We're talking some real high-stakes gardening here, folks. Now, at this point, you might think that investors get turned off by the high price of tulips and find some other alternative. Like, I don't know, my mom loves a tulip, but she'll also fuck with a daffodil. But nope. Investors actually believed that the more expensive the bulb, the wiser the investment that it was. Sound familiar? And in the years leading up to 1637, Lipomania went full throttle. Whole pieces of property, furniture, and jewels were traded for a single bulb. One bulb could trade for like 10 times a common person's annual salary. And then financial instruments like options and futures were created around the excitement for tulip bulbs. There are many people that thought that the price of a tulip bulb could or would never fall again. You'll never believe what happens next. The bottom fell out of the market. Now, before I get into the mechanism that causes the price of tulips to fall, leaving economic wreckage behind in its wake, let's talk about another big boom and bust, but this one in a more modern era. Now, this is probably really hard for some of you youngins to imagine, but there was a time not so long ago when you couldn't DM somebody a photo of your butthole that would self-destruct in 24 hours. That's right, there was no internet. And then, quite all of a sudden, there was. Just unlimited information and unsolicited dick pics all at our fingertips. And the excitement and the growth potential was very real. And naturally, companies and investors wanted to take advantage of that growth. And an environment emerges, one where tech companies, who had never actually earned a dollar in their short lives, were seeing these massive inflows of investor money, both private investments and public investments. And by that, I mean people like us buying internet company stocks. Which, by the way, when you're buying into an investment that has no clear path to profit, that's speculation, known by another name, gambling. Okay, anyway, so fervor is at an all-time high. Stock prices for these new internet technology companies mushroom to levels never seen before. To understand what happens next, the bubble bursting, it helps to understand why the bubble is happening in the first place. We're dealing with a couple of forces at play. First, it is important to understand that in the short term, investment prices are a function of demand, not necessarily a business's fundamentals. Remember our old friend supply and demand from Econ 101? If everyone wants a thing and more people buy in, that is an increase in demand, and that's what pushes prices higher. So that's one force. And then next, add a big old heap and spoonful of wacky human behavior on top. Like, let me ask you this question. Why is something considered cool or not cool? Why is something valuable or not valuable? A lot of it has to do with the reality that humans are very much herd creatures. We often do what our peers are doing simply because our peers are doing them. Look at any fashion trend and how quickly we are willing to jump on it, often to impress our friends. And although cold shoulder tops are definitely the worst, the inclination to signal ourselves as part of an in-group, which has long been essential to our survival, is totally understandable. Justice for cold shoulder shirts. Well, now replace clothing with an investment, one that's sure to get you rich quick, right? Like if all of your friends are making tons of money on internet stocks, wouldn't you want to as well? Of course you would. And so you buy for that reason and that reason only. And that is a very simplified version of what happens in investment manias, which is what Robert Shiller, author of Irrational Exuberance, explains as a series of positive feedback loops. So imagine stock prices for a particular category, internet stocks in this case, experience a price boost. The stocks get more media and print coverage, which further stokes prices. Then the guys that were lucky enough to be the first investors make loads of dough and then brag to all their friends about how rich and smart they are. This influences even more people to invest who, despite reservation for what seems like unusually high prices, are irrational with envy and simply cannot help themselves. Again, positive feedback loops. But alas, there comes a point where demand can no longer run off euphoria only. It's like me on day 3 of a music festival when the serotonin well in my brain has run bone dry. I have to go home. And just like I might pull an Irish goodbye at the music festival and leave without telling anyone, investors also quietly start to sell their trendy stocks to secure whatever profit they can. Demand is waning. More and more people want to sell because they see prices creeping downwards until it's an all-out exodus. And then the prices in that category progressively collapse. This is a feedback loop in the opposite direction. Selling spurs more and more selling. If all of your friends were selling out of their internet stocks, wouldn't you want to as well? Of course you would. In the early 2000s, it boils over into a full-blown panic where all stocks, not just internet stocks, are being ditched and all prices drop. Value across the board is destroyed. Kittens, comrades, we have ourselves a bear market. And this is the exact same thing that happened with tulip bulbs. The bubble is initially pricked by a few prudent investors that sell their bulbs to crystallize profits, and then that sets off a cascade effect. And this is the exact same thing that happened with tulip bulbs. The bubble is initially pricked by a few prudent investors that sell their bulbs to crystallize profits, and then that sets off a cascade effect. And so in investment markets, from time to time, we have these periods of irrationality where on the upside, we can get way too tantalized about something, or on the downside, we can be way too sad and way too reactive. And ultimately, these fluctuations are all caused by us, the messy humans, the investors. The call is coming from inside the house, y'all. A telltale sign of a bubble is the very mania I just described. People often view new investment types or technologies with religious fervor. They believe in it for the sake of believing in it, not because it provides any real utility or reasonable plan for future returns. Maybe right now you're thinking, is this bitch talking about cryptocurrency or what? Maybe not. I mean, Justin Bieber did just buy a picture of one of those Bored Apes for $1.29 million, but I'm sure that was a sound investment. And we very well could be in a bubble for crypto or for NFTs. I would not be surprised if at some point some whales, which are the largest holders in certain digital assets like Bitcoin, start to sell off their positions for the next big thing, which then causes a tidal wave effect, likely hurting the most vulnerable investors at the bottom. But here's the thing. Even harder than predicting if this would happen is predicting when it would happen. Anyone that claims that they know when is real full of shit. And maybe the next bubble that we experience won't be in the digital assets markets. Maybe it's in the stock market, in the real estate market. Maybe it will happen around something that we aren't even talking about yet. But it'll happen eventually. And the mania that we are experiencing in the Web3 markets does feel a little bit unusual. But again, it's too hard to know when we are in it and what form it will take. Sometimes the bubble to crash pipeline can only be fully understood in retrospect. And this means that it's really important to know when you are investing and when you are gambling. Like, are you buying something on a whisper and a prayer, or because you think that it's cool, or your best friend told you to, or some Reddit bro told you to? Or are you buying something because you have a thesis for owning it? What you do during a crash is a little bit different based on the degree of speculation involved in the investment. If it is a crash in a purely speculative investment, well, I can't tell you what to do there. I have no idea if it will come back up or not, and frankly, neither does anyone. Like, on the one hand, gold persists as a store of metaphorical value and real value. On the other hand, Beanie Babies have not. And this is not to say that there's no speculation involved in the real estate market and the stock market, but if you look at the historical returns of both markets, you have seen crashes, but then these markets have recovered just swimmingly and then some. And so if we do experience another crash that permeates the stock market, history tells us it's not actually a good time to sell out, especially if you're invested in a broad way. Like, for example, you own the entire US stock market via an index fund. Not a good time to sell that. Now, I do not encourage market timing whatsoever. Just simply keep a consistent practice. Buy in every month or as often as you can. But just generally, it is good to buy investments for cheaper and not more expensive, right? Like, would you rather buy a house for cheaper or for more expensive? Would you rather buy a share of ownership in a company, which is what a stock is, for cheaper or for more expensive? For cheaper, right? But this is really hard to keep in mind when everyone around you is in a panic and everyone is telling you to sell. We're herd creatures, remember. Crashes don't necessarily mean that an investment is broken either. Look at internet or more broadly technology stocks that have seen a meteoric rise since their initial crash more than 20 years ago. And yes, again, there is a little bit of speculation happening here, but it's also because these leading tech companies have actually become significantly richer over time. And the profits of these companies are ultimately the engine that drives share prices over longer periods. You're buying into a company that is actually incentivized to create wealth, to create profits, right? A tulip bulb can't do that. And as time presses on, we will see investment markets shake off the drama and the noise that we create in the short term, and over longer periods, do a much better job at reflecting real value. Like and subscribe to learn more.